Welcome back to another Zero DTE video, and today Ernie's going to be talking about trade timing, so make sure you stay tuned. If you're interested in becoming a pro trader, check out the link in the description where you can find Ernie's education platform. Enjoy, guys.
So this is a study I did when volatility was in the 25, 26 range. The VIX was in that range. And what I did was I looked at all these different widths across the top here from 10 all the way up to 35 wide on the SPX. And then I looked at the amount of value that was achieved right at the center strike of those butterflies at half-hour increments throughout the day. And you can see here, now this is something you don't see today. Like if I put on a 10 wide at the beginning of the day this morning, you would see that at 9:30, it already had some value in it, probably like $10 to $20. And that's because the VIX is down around 12 or so, or even lower. But when the VIX was around 26, you didn't see any value in that 10 until the afternoon sometime. So what this is saying is that overall, narrower flies take longer for the value to start showing in that fly than wider flies do. And VIX and the volatility also has the same effect on it, that lower volatility tends to suppress the decay and the value of a fly early on at zero DTE day. But once you get beyond around 1, 2 o'clock, the effect of volatility starts diminishing, and then time becomes the final arbiter, and then everything is equal from then on. Width and volatility definitely have a strong effect on how much premium has advanced, or the value of a fly has advanced in the first half of the day, or the first part of the session of that zero DTE day. And adjusting to those changes over time are something that you'll learn. I'm telling you what it is so that you can start observing it and start playing it. You don't have to learn it. Volatility is a good thing for us. Avoiding volatility is not the answer. There are reasons why we want to get in early, because volatility tends to be much higher in the morning. And when you enter a market where volatility is high, you're going to get a suppression of the advancement of the butterfly's value. That means that you can get into it cheaper, and so you'll have greater potential return, right? And then when volatility drops, usually in the mid-morning or the early afternoon, that accelerates the premium decay and the advancement of value in a butterfly. So that can benefit you while you're in the trade. But it doesn't always happen that way. That happens about 2/3 of the time. The rest of the time, it's doing something completely different. Volatility might be low and then go high later on and then go low, or it might be high in the morning and then stay high until the afternoon. If I just said average and you always wanted to enter at the same time, which I don't think is the best thing to do, but you could try that, then you're going to hit the average more often than not right around 10 o'clock as being your ideal time. But then you're going to miss out on all the times that you could have got in right after the market opened when you had like a huge move that could have benefited you.
Thanks for watching, guys. I hope you enjoyed the video, and if you did, make sure you hit that subscribe button and hit the like button below. If there's any questions that you might have for Coach Ernie, make sure you leave them in the comment section. Thanks, guys.